Good morning. Today we're going to discuss the NCI at fair value question. So first of all, read this question. The drafted financial statement of the position of PS and SS company on 31st December 2022 were as follows. It is given. So the P acquired 70% of AS on 1st January 2020 when the reserves stood at 50,000, sorry, 15,000, sorry, 50,000. And acquired 80% of the holding in SS on 1st January 2021 when the reserves is of SS is 60,000. It is group policy to measure the NCI at fair value. The fair value of the NCI at S on 1st January 2020 at the date of acquisition it's given 50,000 and the fair value of the NCI in SS on 1st January 2021 is 100,000. Prepare the consolidated statement of financial position. So in order to do that, firstly we need to identify whether this group structure is a vertical or the mixed or D-shaped group structure. This is a vertical group structure because parent made 130,000 in order to acquire S, and S in turn S made 120,000 to acquire. Since there is no direct investment made by parent to acquire its subsidiary, in that scenario, we can recognize this group structure as a vertical group structure, not a D shape or the mixed group structure. So with that note, we can go ahead. Firstly, we want to sketch a diagram for the group structure. I think the Excel is visible to you all. Is it visible? Yes. Firstly, P acquired 70% of the S and S acquired 80%. 80% of the SS. 80% of the SS. So the effective interest of the SS from the perspective of parent, it is 70% into 80%, that is 56%. Remaining 44% goes to the NCI shareholders. So with that note, we can prepare the group ledger, the cost of control account for the S, cost of control account for the SS, return earning for subsidiary, return earning for uh, subsidiary, consolidated return earning, NCI, and the stated capital of S and stated capital of SS. After that, we can prepare the consolidated statement of financial position, right? So let's move to the question discussion. I think that's yes. P acquired 70%. So we firstly we want to recognize the opening balances, put the opening balances. The stated capital 120,000 it is in the subsidiaries book, 120,000 again in the subsidiaries book. The opening brought forward balances of the stated capital. This is subsidiary, brought forward balances 120,000. And again the stated capital of S it is 120,000 in brought forward balance. So with that note, we want to put the opening balance of the return earning as well. The consolidated return earning, it is 200,000. Consolidated return earning, it is 200,000. And subsidiary, it is 180,000 and subsidiary 130,000. So the consolidated return earning open balances and return earning of subsidiary opening balances here. And the return earning of subsidiary opening balances is this, right? With that note, we can go ahead. So we can firstly start the consolidation working from the cost of control account. So we can recognize directly this investment made by parent in order to acquire subsidiary. That is 130,000. Investment account is credit. Cost of control account is debit. This is this. But in turn, we cannot recognize the 120,000 which is made by the subsidiary in order to acquire subsidiary 120,000 because we prepare the consolidated statement of financial statements on behalf of the parent's perspective of view. So in such instance, the parent owns subsidiary up to 70%. That subsidiary return on 80% of this its subsidiary. In such case, since we prepare the consolidated statement on perspective of parent, we can recognize such subsidiary's investment made by subsidiary not to acquire subsidiary up to the parent holdings, that is parent hold only 70% of each subsidiary, because since parent hold subsidiary, in that case only parent directly get the ownership of the its subsidiary, subsidiary, right? So එහෙන් මෙහෙමනේ parent acquire කරා subsidiary acquire කරා subsidiary, parent own parent subsidiary ගත්ත හින්දානේ යාර subsidiary indirectly control කරන්න පුළුවන්. ඒ හින්දා parent ගේ parent subsidiary ගත්ත percentage එකට තමයි අපි මේ investment එකත් recognize කරගන්නේ. 120,000 into 70%, 120,000 into 70%, that is 84,000. Here you can see the formula bar. 84,000 remaining goes to the NCI. 120,000 minus 84,000, that is 36,000, right? Right. When we go to this one, so 70%, the reserves is 50,000. The reserves are 50,000. In that case, the reserves mean the retained earning, right? Return earning, it is 50,000. So no proposition, return earning 50,000 is here. And the return earning of S is debited by 50,000. That is the double return earning of subsidiary debit, cost of control of subsidiary credit, right? The stated capital, since there is no issuance of stated capital, we can recognize this 120,000 as it is. The stated capital account of subsidiary is debit. Here you can see debit, and stated cost of control account credit, right? Stated capital here. Similar way you can do this for the SS as well, 60,000. So the return earning is debited by 60,000 in the SS return earning, and the cost of control account credit by 60,000. As the stated capital also similar, stated capital debit by 120,000 and cost of control credit by 120,000. So after in that case, necessarily recognize the NCI. NCI at subsidiary is 50,000. In cost of control account debit, and NCI account is credit. Similar way, you can do this for remaining one as well, the 100,000. So cost of control account debit 100,000 in SSCOC, and the NCI account is credit by cost of control SS 100,000. That is the entries that you need to put in this regard. So with that note, we can go ahead. So we can recognize the goodwill. After balancing these accounts, you can recognize here there's 10,000 goodwill, no any gain on bargain purchase. And here it is 4,000. And the return earning, so 120,000, 50,000 goes to the pre-acquisition return earning. Then remaining distribute among, since this is for subsidiary, no? This is for subsidiary. In such case, you can recognize 70% goes to parent or the consolidated return earning. So we recognize 91,000 return earning of subsidiary debit, consolidated return earning credit. Right? Right. The remaining goes to the NCI account credit and return earning of subsidiary debit. Here you can see. Similar way, you can do this for this 130,000 opening balance, 50,000 is pre-acquisition return earning, then post consolidated return earning, remaining balance would be divided among 56% and 44%, right? So you want to keep remember after balancing these accounts, we can recognize. So after balancing these accounts, you can recognize these balances. For the PP, just no disposal or no new addition of the PP, since we can directly line by line addition, put the line by line addition. 150, 130,000 and 200,000, that is 480,000. 480,000 goodwill, it is 14,000 because 10,000 plus 4,000, it is 14,000. 14,000 and current assets 90, 80, 70, it means 70, 70, 140, 120, 150,000. 2,40,000, right? Right. Equity, the parent portion, 100,000. So you can recognize 100,000. And the consolidated return earning, what is the balance? Here you can see 330,200 consolidated return earning. And the NCI account, such NCI account, 183,800. 183,800. And the liabilities, what is the amount? Liabilities, it is after line by line addition, 120,000. So that is the answer, 734,000. The answer is balancing. That is the simple. I know that I'm a little bit fast. This in order to get the idea only I do the previously we do a big question in NCI at proportionate basis. Here NCI at fair value method. The fair value method is little bit easy, right? So there is no required for question number 2 and 3. 3 is a good question. Let's do question number 3. 2 also good. 3 we will do that because that is a, vertical groups, not vertical. That is a good question in mixed group. Right? We will do that. Thank you.